think it's fair to say that the housing market is broken. We're seeing existing home sales hit levels that we haven't seen since 2008. Yet we keep hearing this narrative being pushed that we should consider buying a home now, because when mortgage rates go back down, buyer demand is going to flood the housing market, and we're going to start seeing listings get multiple offers, and home prices are going to skyrocket, making it a very difficult time to buy a home. And after all, even if we get a high mortgage rate now, we can always refi when rates go down, right? Well, what happens if things don't pan out quite as simple as they sound? The fact is that this is all being talked about at a time where the cost to buy is significantly higher than the cost to rent. Mortgage rates are hovering at 7%. Mortgage applications, aka buyer demand, is at the lowest level that we've seen in over 20 years. Now, of course, one of the key drivers for this argument is that supply and demand is completely out of whack here in the housing market, and we have a structural shortage of housing units that are available. And a lot of that has to do with housing starts. So this chart is a really good illustration of that. It shows housing starts per 1,000 households. Between 1960 and 1990, we averaged 22.2, but between 1990 and 2022, it dropped down to an average of 12.2. You can see there was a significant decline during the Great Recession, but we've never fully recovered. And now that mortgage rates have gone up over the last 2 years, we've started to see home builders start to slow down again. Now, the idea here is that if we don't have more supply hit the market, home prices are not going to fall in any meaningful way. Now, I am not here to argue that point. It's certainly a scenario that could play out, but what happens if the economy goes into recession? Or what happens if somebody buys today and is not able to refinance here in the future? So in this video, we're going to reveal some of the scenarios that could play out even if mortgage rates were to go down, and what we need to do to prepare. Before we jump into the details, please hit that like button and consider subscribing. It really helps grow and promote the channel, and I greatly appreciate it. One of the first things that we need to consider is what is the probability of a recession actually taking place in 2024? In order to do that, let's take a look at this chart, which shows whether or not the yield curve is inverted. The inversion of the yield curve is often interpreted as a signal that investors expect economic conditions to deteriorate in the future. And if we use 0 as a baseline, anything above 0 indicates a normal yield curve, meaning that the yield for going out 10 years in duration would be, and should be, for that matter, higher than the yield on the 2-year. Anything below 0 indicates that the yield curve is inverted and the 2-year yield is paying more than the 10-year. Now, at the moment, we are seeing a significant inversion of this yield curve. And if you go back to these other times where the yield curve inverted, once it uninverts is when we saw recessions, indicated with these gray bars. Now, at the time of this recording, the 10-year treasury yield is coming in at 4.186, and then the 2-year is coming in at 4.6. So we're actually seeing a deeper inversion of the yield curve as we speak. Now, as I mentioned, we generally don't see a recession until the curve uninverts, but at the moment, the yield curve is screaming hard landing, which means that the probability is high that at some point in the future, we will in fact go into recession. So then the question becomes is what happens if we do go into recession? And to illustrate that, I pulled up a chart of the Fed funds rate and the yield curve to take a look. Now, if we go out throughout history, different times when we had recessions, here's the dot-com boom, here's the great financial crisis, we can see that the Fed funds rate has actually gone up leading into a recession. As we went into the recession, the Fed funds rate started to go down and the yield curve started to uninvert. This happened in 2001. This happened again in 2006. This also happened in 2020. And it almost looks as if this is something that's starting to pan out right now, yet the Fed has not dropped interest rates yet. Generally, what happens if the Fed drops the Fed funds rate, mortgage rates tend to fall too. We can see that happen in 2001. We could see that rates actually fell during the great financial crisis. So they fell as home values were falling as well. Rates went down in 2020. And of course, that means that it is possible if we go into recession in 2024, mortgage rates will fall along with it. Now, if mortgage rates do come down, there may be a great opportunity for anyone who's purchased over the last couple of years to refinance, drop their rate, and lower their payment. And of course, it would also improve affordability for anyone looking to buy. But what happens if we are in a recession and those borrowers are unable to get financing? In fact, banks may be unwilling to lend even if rates are down. Because what happens a lot of times during a recession is that we start to see tightened lending standards. Banks and financial institutions will tighten their lending standards during economic downturns. And there is a scenario where they could become more selective and more cautious when they're approving these mortgage applications because they want to reduce their risk of default, which means that they may reduce the availability of different mortgage products. They could limit the options available for borrowers, particularly those with unique financial situations. And even your standard Fannie Mae, Freddie Mac backed loans, through the government sponsored entities, those that use the automated underwriting system, even their algorithms start to change. They start requiring higher credit scores, more money down, lower debt to income ratios, making it much more challenging to actually secure financing. And here's just a little anecdotal story for you. I remember back in 2012, I was working for a major financial institution, a large bank. All of you would know who it was. And I was in their mortgage lending division. I was working with a borrower to help him refinance his property. Now, this was a very well qualified buyer or borrower. We would consider him A paper. So excellent credit, excellent income. He was W-2 wage earner. He wasn't self-employed, very cookie cutter, and he had a tremendous amount of equity in the property. So his loan to value ratio was excellent despite property values coming down pretty substantially. And his refi took 6 months from start to finish. And it wasn't of any fault of his own. It was strictly the bank's ability to kind of work through their pipeline and their willingness to actually get that loan done. And so the point of me kind of sharing this story is that even in situations where rates are lower and the borrower could benefit from a lower rate and a lower monthly payment, banks start tightening up when we're in the middle of a recession. And a couple other things that could happen is these lenders, they start having stricter documentation requirements. So the lenders become more stringent in requiring documentation to verify income, verify employment, and other financial details. Maybe they want more reserves, or maybe you're in a situation where your income is variable. In other words, the bulk of your income is derived from commission or bonus income, and that fluctuates. If they start to see that that bonus or commission income is trending down, they will no longer average it over a 2-year period. If it's going down, they're going to take the lower amount, which ultimately makes it harder to qualify for that mortgage. And then, of course, we could see bigger impacts to credit scores, because a lot of times economic downturns can impact individual scores through things like job loss or financial struggles. They lead to missed payments. They lead to increased debt levels, which of course negatively affect credit worthiness. And then the last one that I want to touch on is reduced income and job insecurity. Because if you go back throughout history, it is not uncommon to see as we go into recession, the unemployment rate can jump substantially in a very short period of time. If you look back in the early 2000s, we saw unemployment jump from about 4% on up to maybe 6.5, 7. During the great financial crisis, we were just under 5%. And in about 12 to 18 months, it jumped up to nearly 10%. And look, all of this being said, it's not to be doom and gloom. It's not even to say don't buy a home. Instead, it's to help you get prepared for the possibility of a challenging housing market. Because those risks that I mentioned, they're all things that we can work on together by trying to become indispensable at work, reducing high interest credit card debt, building and maintaining an emergency fund, and of course, living well below our means. And if we do those things and we could still comfortably afford to purchase a home, that's fantastic. But if we're stretching a little bit too much in the hopes that rates are going to come down and we can lower the payment, well, then the risk of having financial challenges obviously is going to increase substantially. Of course, personal finance is personal. So at the end of the day, that decision to purchase a home is going to lie on the home buyer. That's going to wrap it up for today. If you found any value in this, please consider liking and subscribing. It helps grow and promote the channel, and I greatly appreciate it. Take care.